Chapter 16, and Chapter 16 is Introduction to Managerial Accounting. The main learning objective of that chapter first is to define what do we mean by managerial accounting and understand how it is used. Second, to describe the main differences between service, merchandising, and manufacturing companies. 3, to classify costs for services, merchandising, and manufacturing companies. 4, to prepare an income statement and a schedule of cost of good manufactured for a manufacturing company and calculate the cost per unit. 5, to calculate the cost per service for a service company and cost per item for the merchandise. Let's go for the first learning objective, which is to define managerial accounting and understand how it is. First of all, as we all know, we have to find out that the information to be provided by the financial accounting is an input for a lot of other types of accounting. And this is actually what we are trying to explain here. We have that the accountant is doing his job through the financial accounting in order to provide information, okay, about the economic activity to be done by the company. This will be taken into consideration by the users of the financial and managerial accounting, and that at the end will lead us to take a good decision. So actually a good decision is a must for running the business. How to take a good decision? By getting a good information. In that case, if we are talking about the financial accounting, we already explained who are the main user for the financial accounting, and in that chapter we are going to discuss later the main users of the managerial accounting. What is the main difference between financial accounting and managerial accounting? Financial accounting are used by investors, creditor, and the government authority. Those are the main users that the financial accounting system provide them with information. For the managerial accounting, reports are generated for planning. And one planning tool is what we call budget. What is budget? Budget is an expectation for the future. And actually the expectation including an expectation of revenue, expenses, and other financial elements. So managerial accounting are to be used for generating plans for the future, to control, which means to evaluate the plan and comparing the actual result to the budget result, and then to weigh the cost and the benefit, which is the cost analysis or the cost benefit analysis. Your managerial accounting is about planning, controlling, and weighting or using cost benefit. So actually, if we can look here, we can find out that the financial accounting versus managerial accounting is the first aspect of differences is the primary users. Who are the main or the primary users for the financial accounting? As we said before, external, investors, creditors, and government. For managerial, they are internal users, including the company managers and employees. We are not providing this information for external users because actually this information to be provided only for inside users in order to take decision. What is the purpose of that information? Number 2, help investor and credit to make investment and credit decision. Investment, which means to invest their money in the company, and the credit to lend the company money. In the managerial accounting, we help manager and employee plan and control operation. Plan and control, as we just said in the previous slide. 3, what is the focus and the time dimension of information? Usually financial accounting is providing information that is relevant and faithfully representative, and it focuses on the past because actually we are preparing the financial statements for the previous year, the year that has just ended. On the other hand, in the managerial accounting, we are focusing on relevant information and we are focusing on the future because actually as we said, we are concentrating on the budget, the plan for the future, okay, and use these forecasts in the future to evaluate the performance of the previous year. 4. What are the rules and restrictions for each type of accounting? Actually here, it is required in the financial accounting course. We are required to follow generally accepted accounting principles or the national accounting standard that we are using depending on each country. The public company is required to audit it by the independent CPA, and at the end of the year, some independent person, certified public accountant, comes to make sure that the company has complied with the standards. But actually in managerial accounting, we are not required to follow GAAP because actually this is an internal issue. We don't need to comply with the specific rules or regulation. 5. The scope of information. Actually, in financial accounting, the scope of information is a summary report, prepared primarily on the companies as a whole and usually a quarterly or annual basis. It is a summary. When you look to the balance sheet, to the income statement, you see totals rather than details. So we are preparing financial information on summary reports. In managerial accounting, we would like to go for details. So actually we have detailed reports prepared on parts of the company, maybe product, department, territories, okay, or even daily or weekly basis. 6. Behavioral. In financial accounting, we concern about adequacy of disclosure. Behavioral implications are secondary. Most of what we are care about in the financial accounting is disclosure, to provide the information. On the other hand, managerial accounting is concerned about how report will affect the employee behavior, because all this information will lead the employee or the manager to take decision in a specific manner. So at the end, we can say that management accountability is the manager's responsibility to the various stakeholders, and you have to pay much attention for the term stakeholder, not stockholder or shareholders. Stockholder or shareholders are the owners of the company, but actually here stakeholders are all the peoples that are concerned with the company. The supplier can be considered as one of the stakeholders. The customer can be considered as one of the stakeholders. The competitor can be considered as one of the stakeholders. So actually the stakeholders are the main responsibility of the management, because actually they are going to be affected. They are going to be affected by the decision to be taken by the management. Stakeholders have an interest in the business and include customers, creditors, suppliers, investors, as we said before. If you are looking here, we have management accountability to stakeholder. Supplier, for example, is providing us with product and service, so our responsibility as management to make timely payment to supplier. Employee, time and expertise to the company. We have to provide them with a safe and productive work environment and paying wages and salaries. Customers, providing us with cash, so we have to provide them with product and service that are safe and defect-free, backing up the product and service provided. This for the operating activities of the stakeholder. About investing, assets vendor, providing us with long-term assets, so actually we have to make timely payment to them. Financing, investors through cash and other assets, providing return for their investment. We have to provide them with return on their investment. Creditors, providing us with cash, repaying, and our responsibility is to repay the principal and interest for them. Action that affects society, like government, providing us permission to operate, and we have to obey law and paying taxes. Communities, providing us with human and physical resources, the society, so actually we have to operate in ethical manner to support the community, ensuring the company's environmental impact does not harm that community. Today's business environment, we are shifting toward a service economy. If you can imagine now the global competition, because actually most of the companies, the big companies, the multinational companies now are a service company. Okay, and actually the time-based competition drives the businesses to start using a lot of technological and new techniques to manage their business, like the enterprise resource planning, which is system to be integrated in the companies to provide up-to-date data. the e-commerce that allow company to sell product to customer around the world, like Souq, like Jumia, like Amazon. Just-in-time management is an inventory management tool that can keep or cope with the new trends of using technology by providing the products, the inventory, on a timely basis to satisfy the requests of the customers. Learning objective 2. What are the main difference between service, merchandising, and manufacturing? If we are looking here, the service company is sell their time, skills, and knowledge. We don't have a tangible product. All of their costs are period costs related to the service that they are providing within the current period, and are expenses in the period incurred to be deducted in the income statement during the current period. Merchandising companies resell products they previously bought from supplier, because merchandising company are purchasing product and resell them again. Okay, so actually the cost of goods sold is inventoriable product, because it is the part that you didn't sell of your product. So actually it can be stored. It can be stored. And it is also called a product cost. Product cost. The manufacturing company are creating products that the customer wants, but actually the manufacturing company are getting the raw material, then manufacturing or processing them in order to reach for the customer in the way. Here we are going to concentrate more on manufacturing company, because in the financial part, chapter 1, 2, 3, 4, 6, we were concentrating more on the service and merchandising company. It is now the time in that managerial part to look at manufacturing company. Manufacturing company converts raw material into finished product. And as the merchandising company has inventory in their balance sheet, actually the manufacturing company has 3 types of inventory. We have raw material inventory, material used to manufacture the product; work in process inventory, goods that have been started but are not complete, which means we started to produce product but we didn't finish it 100%, and the year has ended. So the amount of the products that is semi-manufactured, incomplete, are called work in process inventory. Finished goods inventory, completed goods that have not yet been sold. Completed goods that have not yet been sold. Those are the finished product that the company didn't sell up till the end of the year, and actually they are remaining in the warehouse, so actually this is to be called finished goods. Yeah, so the 3 main types of products are raw material, work in process, finished goods. This is the financial statements, okay, for the 3 types of the companies. Actually here we starting by the service company, then merchandising, then manufacturing. In the service company you will find out that we have revenue and expenses, income statement, and we don't have inventory. But in the merchandising company, and as we discussed in chapter 6, you will find out that we have beginning inventory, we have ending inventory to reach for the cost of goods sold. And actually this ending inventory will be present in the income statement here, okay, as you can see in the balance sheet of the company. In the manufacturing company we will have the same beginning and end, okay, but we call it here the finished, not a merchandise inventory. And in the balance sheet we will have 3 types of inventory: the raw material, the work in process, and the finished goods inventory. Those are the main differences between the 3 forms of. Learning objective number 3, we will start to classify cost for service, merchandising, and manufacturing company, which means we are going to get introduced to the different companies. I will start by the classification of cost in a manufacturing company. Actually, the cost in a manufacturing company called the product cost. And the product cost include direct cost and indirect cost. The direct cost, a cost that can be traced to cost object like direct material and direct labor. The indirect cost are not traced to cost object, and it is called manufacturing overhead. The direct cost is the cost that you can identify in the product in a simple way. If I'm going to look for a wooden table, so actually the main material here is wood, and the main power that has converted this raw material into product is the labor. And I can estimate, I can find out the cost of both very easily, because I can measure the wood and know how many meters the table need and how many hours by worker to manufacture this table, and those are very easy to find out in an economic, feasible way without incurring any additional cost. But on the other hand, the manufacturing overhead are including all the indirect costs which cannot be traced. For example, the glue to be used in joining the parts of the table actually cannot be determined in a precise way, because actually it is very difficult. It is not impossible, but it is very difficult to know exactly how much glue have been used in joining the parts of each table. So actually here we are estimating the manufacturing overhead. We can know the total at the end of the year, but for each product, for each job cost, as we are going to be introduced later, actually we have to estimate that cost, because we cannot trace it to the cost to object in an economic visible way, What are the main items of the product cost? We have direct material, which is the raw material that's used in production. We have direct labor, which is labor of employee working on the product. Manufacturing overhead, the indirect product cost associated with the production, like indirect material, indirect labor, and factory overhead. Indirect material, of course, we are talking about the glue, as I said, screws, for example, maybe paint, and indirect labor, maybe I'm talking about the supervisor of the labor that is manufacturing the table. The supervisor here is a manufacturing cost, but actually it is indirect, because actually he is not involved in the manufacturing process in a direct way. So actually this is indirect. The other cost that cannot be classified as indirect material nor indirect labor, we call it factory cost or other overhead. And this is include rent, for example, of the factory, utilities, electricity, water, gas, insurance for the factory. All of those are indirect costs that we can add them up and call them manufacturing overhead. Indirect material plus the indirect labor plus the factory costs are to be called. As you can see here, this is some classification of costs. For example, if I'm saying depreciation on manufacturing equipment, it is a manufacturing overhead because actually it is on manufacturing and it is not material and it is not labor. Depreciation on office equipment, it is not product because actually it is not related to the factory, not related to the manufacturing process. So it will be classified as a period cost. Advertising, it is a period cost. Property tax and insurance on office, it is because again it is office, it is a period cost. Property taxes and insurance on factory, here I'm back to the product cost and under manufacturing. Production supervisory salary, the supervisor as we explained in the previous slide. CEO salary, okay, he is running the business, but actually he is not involved in the production. So actually this is a period cost, selling and administrative. Wages for assembly line workers. Assembly line, the line that assembles the product. So actually they are direct labor. Batteries, processors, and other material used in making tablets. Again, this is direct material. Manufacturing supplies. Okay, manufacturing overhead. Freight cost on purchase of material, it is direct material. Delivery expense, it is a period cost. Here comes to find out two special forms of cost, which is the prime cost and the conversion cost. And actually here, the prime cost is a combination of the direct cost plus direct material plus direct labor. And the conversion costs are to convert raw material into finished, which is direct labor plus manufacturing overhead. And this figure is represented that very clearly. We have direct material when it is with direct labor, so it is prime cost, and this is manufacturing overhead, and whenever it is with the direct labor, it is the conversion cost. Learning objective 4, to prepare the income statement schedule of cost of goods sold, cost of good manufactured for a manufacturing company, and calculate the cost per item. So here we are going to determine the cost of the manufactured products through calculating the cost of good manufactured. Actually, the cost of good manufactured is to be constructed or calculated in order to reach for the cost of goods sold. And the cost of goods sold, as you know, is under the income statements. So actually, the calculation of cost of goods sold will including the finished goods inventory accounts that provide information for the cost of goods sold section of the income statement. And then we have the gross profit, which is the sales revenue minus the cost of goods sold, and we reach for the operating income through subtracting sales and administrative expenses from the gross profit. This is the format of the income statement in a manufacturing company. We're starting here by sales revenue minus sales return and allowance minus sales discount, and we get the net sales. Okay, this is the 200,000 to be subtracted out of the 1,200,000, so the net sales is 1 million minus cost of goods sold. Cost of goods sold is to be calculated through beginning finished goods inventory. This is the first year of the company, so it will be 0 plus cost of good manufactured. This is the first statement that we are going to calculate now to get the cost of goods available for sale minus ending finished goods equal to the cost of goods sold. So actually we have to have the cost of goods manufactured first in order to reach for the cost of goods sold. The cost of goods sold will be subtracted out of the net sales, so actually we'll have a gross profit, and then we are going to subtract all the selling and administrative expenses, as you can see here, in order to reach for the operating income. If we have any other revenue or expenses, it will be like the interest expense. It will be subtracted or added in order to reach for income before income tax expense minus income tax expenses. So we will have the net income. The cost of good manufactured is the manufacturing costs of the goods that finished the production process in a given accounting period. Costs are determined from activities that took place in the past, which means we already include. You can see here, I'm going to add the raw material, okay, that have been moved to the working process and then to finished goods. Whenever it is sold, it becomes a cost of goods sold to be subtracted out of sales in order to result in the gross profit. Then we subtract the selling and administrative to reach for the operating. This part is the period cost, and this is the product cost coming from the balance sheet. If you can see here the cost of good manufactured statement, you will find that we started by the beginning work in process inventory. This is the first item. 2, direct material used. How to calculate the direct material used? Beginning raw material plus purchases of raw material equal materials available for sale minus ending raw material. This will result in the direct material use. So actually that part is to calculate the direct material used. The direct material used, this one. So now I started with the beginning working process, then the direct material used. Okay, then I will go for, this is the second part. The third part is the direct labor. The direct labor. Okay, and the manufacturing overhead is the fourth item, and it will include indirect material, indirect labor, and the other overhead as we talked before. So actually again, these items will be added in order to reach for that total. So actually now we have 3 totals: direct material use, direct labor, manufacturing overhead, to reach for the total manufacturing cost incurred during the year. The total manufacturing cost incurred during the year. Material, labor, overhead. This will be added to the beginning working process to get the total manufacturing cost to account for. There is a big difference between the total manufacturing cost incurred during the year, direct material, direct labor, manufacturing overhead, and when we add the working process beginning, we will have the total manufacturing cost to account for, minus ending working process equal to cost of goods manufactured. This equation or this statement must be memorized by heart. Okay. The second part, which is the flow of cost through the inventory accounts. We started by beginning inventory for raw material, purchases and freight in, direct material available minus ending inventory equal direct material used. And this will go for the work in process inventory, which is the cost of goods manufactured. We started by the beginning inventory plus direct material, of course, work in process, direct material, direct labor, manufacturing overhead, total manufacturing cost minus work in process ending equal cost of good manufactured. Then the cost of good manufactured will go for the finished goods inventory, the cost of goods sold, beginning finished goods. Of course, again, this is work in process. Okay, and this is work in process. And this is finished goods. Okay, يبقى beginning inventory plus cost of goods manufactured minus ending inventory equal cost of goods sold. Now I have the cost of goods that we talked about. Okay, how to calculate the unit product cost? Manager make decision on pricing product. Any price is to be calculated based on a cost plus markup equal to price. Okay, so actually the cost per unit is very important for the manager to take the pricing decision. The cost per unit is found by dividing the cost of good manufactured by the total unit produced. يعني whenever we get the cost of good manufactured, we divide it by the total number of units, so we have the cost per unit. The cost per unit is used to determine the cost of goods sold for the units sold to customers. Okay, so actually now if I have number of units sold 2,000 and I know the cost per unit which is $300, so it is 600,000. So now we reach it for the cost of goods sold if we have the cost per unit, but in the preparation of that into consideration. The last thing that we are going to discuss in that chapter is to calculate the cost per service for service company and cost per item for machine. Actually, we just said that whenever we would like to get the cost for a manufacturing company, I'm going to get the total cost, the total manufacturing cost divided by the total number of units. But actually here in service or a merchandising company, we have to have the total cost divided by the total number of service provided. We don't have cost of good manufacture because this is not a manufacturing company. So we are getting all the total cost divided by the total number of service, so it is the unit cost per service. In merchandising company, we are getting the total cost of goods sold by the total number of items sold, so actually we can get the unit cost per item if we don't have the manufacturing cost. Actually, this is all. Thank you for your concern. See you in the next chapter, inshallah.